my name is Ben Reppond. Today is September 11, 2024. I'm going to cover the market, the stock market, various indicators and movement in the market. First, I wanted to say that last week through Friday was a very negative week in the market. The S&P went down about 4%. The NASDAQ went down about 7%, both of which are a lot for a week. By the end of Friday, I think a lot of people were kind of shaken. I hope no one jumped out of the market based on that, but it was negative. So yesterday I covered some ideas on when you should think about having a strategy to get out and get back in. And so you have to think about how you want to deal with that. Last week was a reminder of how important it is to think about, when you want to get out, etc. So, okay, let's get into the dashboards. These are the major indexes, the 6 major equity indexes: Dow, NASDAQ, S&P, Russell 2000, and the foreign developed markets and emerging markets, EFA and EEM. And you can see here in the yellow box, this is last week. It was quite negative. The bonds were the long-term government bond was positive by about 2%. Everything else was, as you can see, very red. And then in the pink box, you can also see that where it is year to date. Actually, everything is positive, and bonds are about a break even for the year. But all the other indexes have come down because of last week, but are still in positive territory. Because of the magnitude of the loss last week, it is no surprise, hopefully to you, that all of the 6 equity indexes I mentioned, in that first column to the right, the red dots, you can see that everything is below its 20-day moving average. The next column is the 50-day moving average, and all but one of them broke through to the downside the 50-day moving average, and even a couple of them broke through the 100-day moving average. When you get to the 200-day, the 200-day moving average, everything is positive. The market sectors, we went from 42, I think 2 weeks ago we're at 44. We're at 42 green dots all the way down to 25 green dots. And 2, 4, 6, 7 of the 11 sectors broke through their 20-day moving average, and 5 of them broke through the 50-day, 4 of them broke through the 100-day, broke through to the downside. So, and some have stayed above. They continue to be green. So sectors are kind of all over the board. This is a chart of the S&P 500 for a weekly chart showing 1 move equals 1 week over a 2-year period of time. And you can see to the far right, the far upper right, you can see the sharp down move. And that was, of course, the way last week was. The tech sector and the NASDAQ 100 were even sharper down than that, and we'll go through some comparatives here in a minute. But I drew a black arrow because I still see, when you step back and look at this chart, even though it was negative last week, it did not go through the 20-period moving average. It kind of went down and touched it. But when you look at it over a 2-year period, it still is moving in an upward direction. I take that and compress it to the same, the S&P 500, compress it to 18 months rather than 24 months. And in 18 months, you can see, again, the same thing, but you see that red bar in the far right, that is the magnitude of that as a week. That's 1 week of data, not 1 day. Again, sharply to the downside. Usually what happens when you have something that sharp to the downside, sometime in the next week or coming weeks, it will go on down further, because that took a lot of wind out of the sails of the market. So it may not happen this week, but over the coming weeks, it would not surprise me if we see something further to the downside. The NASDAQ 100 is compared here on a relative strength basis to the S&P 500. When the NASDAQ, when it moves down, that favors the S&P 500 over the NASDAQ, and vice versa. So you can see, and I drew a chart here for an arrow here for the last couple of months, the direction of this relative strength is down. So in other words, relative to the S&P, the NASDAQ over that period of time has been moving down and is more out of favor than the S&P, and certainly more out of favor than the Dow. So here we have the comparison of the growth component of the S&P 500 and the value component. So when those two bookends sitting out here, growth and value, are compared to each other on a relative strength basis, if it goes up, it favors growth. If it goes down, it favors value. So you can see in the last couple of months, I did from the black arrow, I drew this, you can see the magnitude, to the degree to which value is in favor over growth. And it's and that's through last Friday. I don't know what's going to happen. I don't know the future. So all I can say is report on this, and I can tell you right now, in that period of time, kind of in an intermediate term period, value is clearly in favor. When the S&P 500 is compared to, which is large companies, large cap stocks, compared to the small cap, which is the Russell 2000, small cap index, IWM, SPY, S&P 500, is the numerator. IWM, Russell 2000, is the denominator. When it goes up, it favors large cap. When it goes down, it favors small cap. So you can see it, since that same period, the last couple of months, that has come down quite a bit, and that's basically favoring small cap. But during some period there, the last month and a half or so, it has come back up, and that is now favoring large cap, or S&P 500, versus small cap. Bonds, the bond ETF, TLT, the long-term government bond ETF, has been moving up for the past several months. It has the long-term picture for, this is a 5-year chart, so over 5 years it has come way down. But in the short run, it's been moving upward, and that's helping out traditional 60-40 portfolios, 40 being the bond portion. But my comment on, I do not use and don't believe in 60-40 portfolios for several reasons, but this is one of them, is that over this 4 or 5 year period of time, is certainly 4, you can see that bonds collapsed. I mean, they went down like 50%. The long-term bond went down like 50%. And I've shown the chart before that shows the 2 long macro periods of time From 1946 up to about 1982, bonds went down because bond yields and interest rates that are correlated went up. So the price of bonds moves inversely to that from 1946 to 1982. So if you held bonds during that period of time, and you want to include that period of time in your analysis, which I think you should, it's not very favorable for a 60-40 portfolio, in my opinion. And then since 1982 to about 2000 or 2021, bond prices went up and bond yields went down. And interest rates followed that as well. I think we're in in the last few years, and this chart is an illustration of that. In the last few years, the last few years, we have entered another macro period that will go for, in my opinion, probably decades. 1, 2, 3, 4, I don't know how many, but a longer period of time, and that's going to put a drag on traditional portfolios that people have not been prepared for. The delusion, I guess, or illusion, is that during the last 40 years, most financial advisors and books that have been written on the subject have looked at that data, and it is compelling. It does make some sense to be in a 60-40 portfolio if all you're looking at is a period of time of declining interest rates and rising bond prices. But things go in cycles, and when we enter this next cycle, if this is it, which I think it is, it's just not going to be very satisfying for long-term strategic 60-40 buy and hold investors. When it goes down, when the market goes down, S&P, the equities or bonds, or 60-40, when it goes down, it usually does not go straight down. It usually goes down like this. It goes down in waves. Going down, tries to go back up, collapses, et cetera, et cetera. And the same on the way up. When it goes up, it usually goes up in waves. And so this particular chart illustrates that from a bond perspective for just a 5-year period. But if you look at the longer term macro view, you can see the same thing happen, up and down over a long period of time. The dollar has pulled back. It's dropped below its 20-period moving average. This last week, it went back up. Sometimes the dollar moves inversely to the equity market. So this last week, of course, equities were down, and it didn't surprise me to see that the dollar went up a little bit. But so relative to other currencies, the dollar is still moving in an upward direction. Gold dropped a little bit, not much. You can see that at the very far right of the chart. It did not collapse. It did not go up. But again, the long-term or intermediate-term view for 24 months is definitely in an upward direction. Silver, however, while it tends to move at times similar to gold, it sometimes is more exaggerated. So while gold went down a little bit, I'll give you the data on this later, but it went down a little bit, silver went down a lot more. So, and you can see that to the far right of the chart, almost, if I have to draw an arrow, which I did, it's basically over the past several months is moving in a downward direction. So I don't know, I don't know about gold, but at this point, they have been more in favor than not. When I put them on a relative strength chart, silver being the numerator, gold being denominator, there is no direction here. It's just a lot of up and down. But you can see over the past few months that gold has way outperformed silver. And again, that's the last part of the chart to the right. The Bitcoin has continued to fall. This is over a several month period of time. Let's see, back to about April. So that's 5 months or so. It's generally been in a period of decline. The volatility index, no surprise because of last week, especially ending with Friday, the volatility index went up to about 22, did not touch the magic number of 24, and you can see where 24 is. Definitely it's moving up in an upward direction. That doesn't mean it's going to go up to or through number 24. It might, but it has momentum on its side, which means the market has a downward bias in the short run. Asbury Research does their 6 metrics, and they 2 weeks ago all 6 were positive. As of Friday, 5 out of 6 are now negative. When you compare different assets one to another, you can see, and this will be supported by the data that I just showed, is bonds are more favored than stocks. I'm going to comment on the ones that are true in all 3 categories: the last week, the last month, the last quarter. Bonds more favorable than stocks. Low volatility more favored than high volatility or high beta. Blue chips, the Dow, more favored than the S&P broad market, and the broad market more favored than the NASDAQ 100, and value over growth and developing markets are stronger than the U.S. Corporate bonds are more favored than government bonds, and corporate bonds are more favored than high yield bonds, and I guess you'd say corporate high quality bonds are more favored than high yield, and long-term bonds are more favored than short-term. Comparing different countries and regions. Now, there are on this list 25 countries or regions. And again, we're going from left to right. We're looking at the most recent month, the week, the last month, and the last quarter. And if they're all 3 are in green, it shows that country or region is more favored from a market perspective, not currency or the economy, but a market perspective than the U.S. And if they're not in green, then it favors the U.S. Those not in green, where the U.S. did better than those, are Chile and Peru, and number 1 and number 3. And then if you go on down the page, Taiwan and South Korea, the U.S. was stronger than. All the others are either mixed, but most of them, those countries have done better than the U.S. So this pullback or whatever happened last week that was negative was heavily oriented to the U.S., but you could also say Taiwan and South Korea are impacted by that because they're heavy in the manufacture of semiconductor chips. So those that outperformed the U.S. were in all 3 categories: Brazil, Canada, Switzerland, Spain, France, United Kingdom, Eurozone in general, Malaysia, Hong Kong, Singapore, India, Thailand. Interesting, Thailand, because they have been way out of favor compared to the U.S. for a long period, and New Zealand and Australia. I chose the chart that I thought had the most consistency to it, so I compared the U.S. to South Korea. So the U.S. over this period of time has done favorably quite a bit of the time, but not all of the time. But when you put it on a relative strength chart, you can see how has the U.S. done compared to Korea. Well, it's been in favor and out of favor, in favor, out of favor. It goes up and down. But generally speaking, it's gone up, which shows that the U.S. has done better than South Korea, or South Korea did less worse than the U.S. if it was a down period. Gold and silver. This is as of last Friday. The spot price on gold, as I said, it came down slightly, 0.2%, and the spot price broke below 2,500 and is now at 24.92. And silver, the spot price is 27.94. That's without the markup, and that is a decline in silver of 3.4%. And the gold-silver ratio is 84-1. A monster box, 500 rounds of generic silver, is now broke below 15,000 for 500 and is now 14,605, and that includes a $1.27 markup over spot. That's $29.21 per round, and this is courtesy of my son Preston. And what's interesting is that it continues to be, for 1 round or more, $29.21. You want to buy 500? Still $29.21. So in other words, in my opinion, this because signaling more of a buyer's market. Okay, we're in a period where the bulls and the bears are fighting it out. And last week was classic. The bears won decisively. In this period of time that's coming, I don't know what's going to happen. I mean, the bulls could absolutely win, and the opposite could be true as well. But just be aware that there is a battle going on Wall Street between the buyers and those who are shorting the market or selling. Thank you for watching. If you have questions or comments, leave them in the comments section below.